Welcome to the Deep Dive, the show that cuts through the complexity of today's world to get you truly well-informed, fast. Today, we're plunging into a landscape that's changing at, well, a dizzying speed.
It really is.
I mean, the KPMG Futures report suggests we'll witness more transformation in the next 5 years than maybe the last 30.
Wow. Yeah.
That's not just disruption, that's a whole new chapter unfolding.
It absolutely is an era of unparalleled transformation.
Yeah.
And our mission in this deep dive is really to help you navigate that rapidly evolving terrain.
Right.
We'll be unpacking the critical forces reshaping business, global economies, even, our daily lives. We're pulling insights from some really insightful reports.
That's right. We've got the KPMG 2025 Futures Report, Goldman Sachs' 2025 ISG Outlook, the World Bank's Global Economic Prospects, June 2025, and a look at future skills from NMSU Global Campus.
Quite a stack.
Yeah, think of this as your shortcut, maybe, to understanding the essential shifts that truly matter for you right now. So let's start by framing this immense scale of change. KPMG uses that STEP framework, right? Social, technological, economic, political.
That's it. And what's really fascinating here, and what they emphasize, is how these forces aren't isolated. They're deeply interconnected.
Okay.
It's their convergence, the way, say, a shift in technology can immediately trigger economic and social consequences that drives this rapid change across every industry.
So it's not just one thing happening over here.
Exactly. It's less about individual events and more about this complex system where, well, every action has a ripple effect.
Speaking of ripples, the global economic outlook seems full of them. The World Bank forecasts some growth, but they also flag significant downside risks.
They do. They point specifically to persistently elevated policy uncertainty and, importantly, increased trade tensions.
And what does that actually mean for investment?
Well, the crucial insight here is that this kind of environment significantly dampens investment globally. Businesses get hesitant, they hold back on expansion,
Right.
and it disrupts global value chains, which, in turn means everything from the cost of goods you buy to job stability can be impacted.
And inflation remains a big question. What's the latest on expectations, especially in, say, the U.S.?
Yeah, the World Bank notes that inflation expectations, especially in major advanced economies like the U.S., have actually picked up in 2025.
Why is that?
It seems to be mainly due to the expected impact of tariffs hitting consumer prices.
Ah.
The critical takeaway for you is that this could mean your everyday costs remain elevated for longer. It challenges budgets, influences central banks, interest rates, loans, investments, the whole picture.
Okay. And what about specific commodity prices? Are there any standout trends?
We're seeing some pretty distinct trends. Precious metals, gold, silver, platinum. That index is projected to jump by over 30% in 2025.
30%. Wow.
Yeah, reaching record highs. This is largely supported by what they call safe haven flows, investors seeking stability in uncertain times.
Makes sense.
But interestingly, on the flip side, energy prices, they're actually forecast to decrease by about 15% this year.
Huh. Okay, let's zoom in on the U.S. economy then. Goldman Sachs has a particular view, right? How do they see its performance compared to others?
Goldman Sachs believes the U.S. economy is, well, continuing to exceed expectations. They clocked real growth at 2.8% in 2024, which is actually above its trend rate.
And inflation cooling there.
And inflation cooling, yes.
Yes.
It's a key contrast because Europe and the UK saw growth below trend.
So less recession risk in the U.S., according to them.
Significantly less. Goldman Sachs lowered its year-ahead recession probability for the U.S. down to 20%. That's way below the general consensus.
Interesting. It does raise the question, can the U.S. keep defying these global headwinds?
That's the big question, and what it means for its leadership role.
And that leads us nicely to China. Goldman Sachs offers a detailed look there with some pretty striking numbers.
Yeah, they do. I mean, China added a staggering $937 billion to its GDP last year. Huge numbers. But its economy actually peaked as a percentage of the U.S. economy back in 2021 at 75%. Now it's sitting at 63%.
So it's dropped relative to the U.S.?
It has. And here's the kicker. Goldman Sachs does not expect China to exceed that 2021 peak.
Really?
They project it might reach a high of 70% by 2034 and then gradually level off.
So what's their analogy for that trajectory?
They view China's growth path as, at best, following Japan's post-bubble path. So declining from that 7.7% average before COVID down to maybe 3% over the next 10 years.
Wow.
Reaching about 2.2% by 2034. It implies a pretty significant structural slowdown.
And didn't they mention debt?
They did. It's worth noting China's augmented government debt to GDP ratio currently stands at 104%.
Yeah.
So that adds another layer to their economic challenges.
Okay, so from those big macro shifts, let's pivot to the technological accelerators. These are really changing everything. KPMG talks about a decisive shift in AI towards general purpose systems. What does that really signify?
This is a fundamental change.
Right,
We're moving beyond AI that's just good at one specific task.
right.
These new systems can reason, plan, learn, and act across different domains with, well, increasing fluidity. Now, the timeline for true artificial general intelligence, AGI, or even superintelligence, ASI,
Yeah,
that's still uncertain.
sure.
But the trajectory, the path towards systems becoming more autonomous, more generalizable, capable of improving themselves iteratively, that is absolutely not in question. We are definitely on that path.
That sounds pretty profound. So what does agentic AI mean in practice, and how does foundational intelligence fit in?
Okay, so agentic AI refers to systems that can observe their environment, interact with multiple inputs like data streams or sensors, and use tools independently.
Tools meaning?
Digital tools, like accessing databases, running code, searching the web. Imagine an AI assistant that doesn't just answer your question, but actively works through a multi-step problem for you.
Okay.
Maybe even deciding which tools to use along the way. Think of them moving beyond just responding to prompts, like we see with architectures like React and AutoGPT.
And foundational intelligence.
That's sort of the bedrock. It's driven by these massive data sets, incredibly sophisticated architectures, and just unprecedented amounts of computing power. This leads to large-scale base models that have a kind of basic general intelligence.
Right.
And this is where technologies like RAG retrieval augmented generation and vector databases, you hear names like Pinecone or Weediate come in. They allow these AI agents to dynamically recall information and maintain context over long interactions. They provide the vast knowledge base these systems need to operate intelligently.
So if AI is getting this advanced, the obvious question is about jobs. Lots of concern about AI replacing humans.
It's a valid concern, but Steve Chase from KPMG offers a really powerful perspective here. He points out that historically, every major tech revolution has actually created new jobs, not just replaced old ones.
That's the historical pattern, yeah.
And he believes this revolution will be about human-AI collaboration at unprecedented scales.
Collaboration, not just replacement.
Exactly. It's about technology working alongside us, augmenting our capabilities, helping us solve incredibly complex challenges, and creating entirely new possibilities we can barely even imagine today.
Okay. Beyond AI, another frontier, also potentially hugely impactful, is quantum computing. How's that evolving?
Quantum is fascinating. It offers these unique capabilities for breakthroughs in areas like optimization, think logistics or financial modeling, cryptography, material science, complex simulations, things basically impossible for today's computers.
But are they here yet, practically speaking?
Commercially viable, widespread quantum computers, not quite yet. But hybrid models combining quantum and classical computing are showing really exciting potential right now.
And it's becoming strategic.
Absolutely. This technology is becoming such a critical area that KPMG even talks about quantum geopolitics. It's a significant field now for national security and economic growth, as nations kind of jostle for dominance.
And then there's the space economy. Feels like we hear about new launches and companies almost daily.
We do. It's expanding incredibly quickly. Projections range from, say, $1.4 trillion up to $1.8 trillion.
Wow.
And it's maintaining this robust compound annual growth rate, CAGR, of like 10 to 20%.
What kind of new markets are emerging up there?
Things that sounded like science fiction just a few years ago. In-space manufacturing, actual space tourism, sophisticated satellite-based data services.
It sounds like space is becoming more accessible, not just for big government agencies.
Exactly. That's the democratization of space trend. It's driven largely by drastically reduced launch costs.
So smaller players can get involved?
Yep, nimble startups, academic institutions, they can now challenge the traditional players like NASA, ESA, Roscosmos.
But there are downsides to that.
There are risks. Space debris, old satellites, bits of rockets is a growing concern. It significantly increases the risk of collisions up there, threatening the very infrastructure we're building.
Right, a Kessler syndrome type scenario. Okay, let's shift focus slightly to economic shifts and strategic investments. Digital assets like crypto seem to be reshaping finance. KPMG noted big adoption in Q1 2025.
Yeah, driven by regulatory shifts. New clarity in digital asset regulation is definitely unlocking institutional participation. We're seeing that.
And the market size?
The overall crypto asset market cap is now around $2.7 trillion. But what's maybe even more striking are the projections for tokenized real-world assets, RWAs.
Putting traditional assets on the blockchain.
Exactly. BlackRock sees that reaching $10 trillion in the next decade. Others, like Security Token Market, forecast an astounding $30 trillion by 2030.
30 trillion. What kind of assets?
Led by things like stocks, real estate, bonds, even gold. It's not just about crypto anymore. It's about the underlying technology.
And stablecoins are part of this? And are the big banks getting involved?
Stablecoins have definitely emerged as one of the most widely adopted digital assets. And yes, what's compelling is that major financial institutions, Citigroup, State Street, BNY Mellon, they're expanding their crypto custody services.
So they don't see it as a threat.
Increasingly, they seem to see blockchain not as a threat to traditional finance, but as a foundational technology for new growth opportunities and efficiencies.
And what about the convergence of AI and blockchain? That sounds like a powerful mix.
It really is. Imagine AI agents using blockchain for automated trading, portfolio rebalancing, completely eliminating manual inputs.
Are there examples?
Yeah, for instance, the Mindshare Index on the NEAR protocol uses an AI agent to scan social media sentiment and then autonomously execute trades based on that.
Huh. Intelligent, self-executing finance.
That's the core idea. The risks, though, are still there. Ongoing regulatory uncertainty, persistent cybersecurity threats. We saw a huge $1.4 billion hack recently, and interoperability challenges between different blockchain networks.
Okay. Beyond digital advanced manufacturing seems to be having a resurgence, particularly in the U.S. What's driving that?
KPMG calls it a policy-driven rebirth. We're seeing this structural shift away from the old labor-intensive offshore models towards more capital-intensive, technology-driven domestic production.
Get behind it.
It's a convergence.
Yeah.
Geopolitical shifts, for one. Then technological advances like AI, robotics, Industry 4.0, smart interconnected factories, digital twins.
Virtual replicas.
Exactly. And policy is huge, too. Government incentives, tariffs.
Any big examples?
Oh, yeah.
Yeah.
Companies like TSMC committing $100 billion to U.S. chip fabs, Siemens investing heavily, Tesla expanding its gigafactory with another $3.6 billion, Eli Lilly putting $27 billion into new U.S. sites, creating like 13,000 jobs. It's a massive reinvestment in domestic production capacity.
And alongside that, environmental resilience is becoming critical for businesses, right? How are extreme weather events factoring in?
They're absolutely reshaping economies. The increasing frequency and intensity of these events means building environmental resilience isn't just, nice to have or about compliance anymore.
It's strategic.
It's a strategic and financial imperative. And what's particularly noteworthy now is the surging demand for energy from AI, from data centers, from the broad push towards electrification. This is sparking new energy investments, things like modular small nuclear reactors, SMRs, being seriously considered for powering data centers.
Wow.
And you're even seeing companies traditionally way outside the energy sector getting involved, realizing that a stable energy supply is just foundational to their future operations.
So given all these complex shifts, where does Goldman Sachs see strategic investment opportunities?
Well, looking broadly, they don't actually recommend a tactical overweight to non-U.S. equities versus U.S. equities right now.
Even with low valuations elsewhere?
Even with those historically low valuations. The reasoning includes slower trend economic growth outside the U.S., lower earnings per share growth potential, weaker demographics, and more geopolitical vulnerabilities.
But not zero allocation.
No, definitely not zero. They note there are still world-class companies outside the U.S. in sectors like consumer discretionary, healthcare, utilities, materials. So it's more about being selective globally, not just betting everything on the U.S.
Okay. What about fixed income or specific sectors? Anything stand out?
For fixed income, they actually recommend overweighting UK fixed income.
The UK. Why?
They expect below-trend growth there, around 1.2%, and a sharp fall in core inflation from 3.7% in 2024 down to 2.7% in 2025.
Which would mean?
Which would lead to declining rates, maybe down to 2.5 or 3.0%. That's actually more aggressive than what the market generally expects.
Interesting. Any sectors?
We initiated an overweight position in European aerospace and defense back in April 2024.
Why that sector?
Driven by increased European defense spending that was up 10% in 2024, and also anticipated pressure from the incoming U.S. administration for allies to spend more. Plus, you look at someone like Airbus, they have an 8-year order backlog, huge demand.
And then there was that rather unique allocation, physical uranium.
Yes, physical uranium. There are a few drivers here. Nuclear energy is increasingly seen as an attractive, carbon-free power source globally.
Right, baseload power.
Exactly. Plus, there's been a sharp decrease in uranium exploration and production since about 2018.
While demand is growing.
While demand is growing, you've got new reactors coming online in China, restarts happening in Japan, global pledges from COP28 and COP29 to expand nuclear capacity,
And supply issues, too.
and supply issues. The U.S. Act prohibiting Russian uranium imports and Russia's expected retaliation that's further impacting supply, creating a tighter market for this critical material.
Okay, that naturally brings us to the wider geopolitical currents and their economic wake. U.S.-China tensions, the trade war, still simmering.
Definitely simmering. Goldman Sachs sees an escalation as likely. Think increased or new tariffs, and China inevitably responding.
Is a deal possible?
Most experts they consult believe a deal to really resolve the core tensions is highly unlikely. They put a 45% probability on unmanaged decoupling, basically, a messy separation of the economies.
And manage decoupling.
That's a 30% probability. Either way, it suggests a really challenging and unpredictable path ahead for global trade, forcing companies to rethink their supply chains constantly.
And cyber threats remain a huge piece of this geopolitical puzzle, with China often highlighted.
Indeed, China is identified as the biggest state sponsor of cyber attacks targeting the U.S.
What kind of attacks?
Everything from stealing intellectual property, gathering sensitive information on hundreds of millions of Americans, like through compromising telecom companies, to actually infiltrating U.S. critical infrastructure.
Critical infrastructure, like what?
Communications networks, energy grids, transportation systems, water treatment plants. According to U.S. intelligence, these systems have been compromised for at least 5 years by actors known as Volt Typhoon.
State-sponsored groups.
Yes, and FBI Director Christopher Wray put it starkly.
Yeah.
He noted that China's army of hackers outnumbers the FBI's cyber personnel by at least 50 to 1.
50 to 1.
It just underscores the sheer scale and persistence of the threat. It's a major national security issue and an economic stability issue, too.
Shifting slightly, the World Bank talks about how this global fragmentation is impacting foreign direct investment, FDI. How are tensions changing where companies invest?
It's interesting. Rising geopolitical tensions have definitely led to more restrictions on FDI flows and trade overall.
Even though developing economies might be open.
Even though many emerging market and developing economies, EMDEs, are generally more open to cross-border capital. This fragmentation seems to primarily affect what are seen as strategic industries.
Like tech.
Like ICT, transport, professional, scientific, and technical services. And investor surveys back this up. They show geopolitical risk, supply chain disruptions, and restrictive regulations are now key factors pushing companies towards friendshoring, nearshoring, or reshoring.
Bringing production closer or to allies?
Exactly. But the result is that FDI inflows into those EMDEs remain challenging. Greenfield FDI, that's brand new investment, was projected to decline by almost a quarter in 2024 compared to 2023.
Because of these tensions and uncertainties?
Tensions, policy uncertainty, weak macroeconomic backdrops. It all feeds in.
Finally, let's touch on something often overlooked. Fragile and conflict-affected situations, FCS economies, which the World Bank covers, these face immense challenges.
They really do. Over half of these FCS economies are currently in active conflict. They face these deep intertwined problems, extremely low institutional capacity, pervasive violence, food insecurity, rising debt burdens.
And the economic cost is huge.
Enormous.
Yeah.
GDP per capita can fall by around 13% after 5 years of medium to high intensity conflict. For really intense conflicts, it's over 20%.
Devastating.
It devastates human capital, physical capital, disrupts trade, kills private investment, creating these terrible cycles of poverty and instability.
It paints a grim picture. But the World Bank does offer some examples of recovery, right? Suggesting it is possible.
Absolutely, and it's important to highlight those. Look at Bosnia and Herzegovina. After its conflict ended in 1995, its GDP per capita nearly doubled in just 3 years.
Doubled?
Doubled between 95 and 97. It regained upper middle income status by 2008. It's seen as one of the strongest post-conflict recoveries globally.
What helped?
Significant, targeted international financial assistance was crucial.
And Cambodia offered a different angle.
Exactly. The end of conflict there allowed Cambodia to integrate into global markets. That spurred industrial expansion, especially in apparel.
Creating jobs.
Generating significant employment, particularly for low-skilled workers, which really accelerated poverty reduction. Plus, a pro-investment policy framework helped attract both foreign direct investment and development aid.
So there are pathways out.
There are. These examples show that while the challenges are immense, strategic support, policy changes, integration into the global economy, they can drive remarkable recovery. It offers a potential blueprint, at least.
Wow. What an incredible journey we've taken today. We've really navigated a complex landscape from, the transformative power of AI and that burgeoning space economy
Hmm.
to the shifting tides of global trade, the rise of digital assets, and these really tough challenges facing fragile economies.
Yeah.
The central theme, it seems, is disruption, definitely, but also opportunity, all shaped by those interconnected forces: social, technological, economic, political.
And understanding these deep trends is absolutely crucial. It helps you, the listener, not just react to change, but proactively anticipate it.
Position yourself strategically.
Exactly. Whether you're leading a business, making investments, or just trying to make sense of this rapidly changing world. It's really about being prepared for those no-regrets moves and spotting the truly impactful shifts before they become obvious to everyone else.
And connecting back to those skills we mentioned from NMSU fields like healthcare, nursing, data science, analytics are clearly in high demand.
Absolutely. The ability to interpret and act on data, and importantly, to collaborate effectively with these advanced technologies like AI, that's going to be crucial for the future workforce.
So maybe a final thought to leave everyone with.
In a world where change just keeps accelerating, where information is everywhere but often overwhelming, what new skill or maybe what new area of knowledge will you dive into next to help you navigate this ever-evolving landscape?